business in Hong Kong continues to grow. Our wealth flows in Hong Kong continue to be very active and growing, so no impact at all.
In the end, the bipartisan group of senators have produced a bill that will dedicate substantial resources to repair, maintain, and upgrade our nation's physical infrastructure.
I am very much encouraging all employees, all Americans, all people around the world to get vaccinated. I think it's very, very important. It is possible that we will come in with a vaccine mandate.
This is Bloomberg Surveillance, Early Edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Here's what's coming up on today's program. HSBC resumes its dividend after doubling profits. Its CFO tells Bloomberg the bank is still betting big on China despite Beijing's crackdown. Let's talk. Beijing wants to discuss with the SEC over its decision to halt U.S. IPOs of Chinese companies. The U.S. infrastructure deal is done. Senators finished the text of $550 billion worth of a package. Chuck Schumer says the bipartisan bill will be passed in a matter of days. Happy Monday, everyone. It is a constructive market, maybe not an exuberant one, but we certainly are heading higher on these equity markets after last week, touching some records, especially for Europe after the earnings. Europe also getting some numbers for July manufacturing PMI coming in at 62.8. That is stronger than the preliminary, just slightly at 62.6. But elsewhere, it really was the Chinese handoff that allowed us to move higher. So you can see on the bottom of your screen there, the CSI 100 closing at higher than 2.5%. China opening the door for talks with the U.S. when it comes to IPOs, and at the same time hinting towards more accommodation with softer PMIs. Now, we also have small caps in the U.S. outperforming. Has big tech leadership ended? Has the baton been handed to those cyclically sensitive companies? Maybe getting hits of that today, but overall, as you can see, a more positive market. Now, the earnings, they do keep rolling in, certainly helping some of the sentiment today. HSBC among them, and HSBC paying an interim dividend after adjusting second quarter profit doubled from a year earlier, and that easily beat analyst estimate. It also cut back further on bad debt provisions, saying the global economy was starting to emerge from the worst effects of the pandemic. Bloomberg's Manus Cranny spoke exclusively to CFO Ewan Stevenson.
We're very, very confident we can hit that dividend policy this year. I mean, I think what we've seen so far this year is capital to continue to accrete into a much better place than where we thought we'd be at this point. Largely driven by credit outperforming relative to where we thought. But relative to 3 to 6 months ago, our capital position's a lot stronger. So we are adjusting our tonality today on capital distributions. We are signaling the fact that relative to the start of the year, where we would have said to you that we were going to continue to be cautious, I think now we definitely feel more confident, and we will keep buybacks under review in the coming quarters together with dividends.
$1 trillion was wiped off Chinese equities globally from Hong Kong to onshore to the United States. Are you unscathed? Did you have any margin calls, any collateral impaired as a result of the wipeout?
No, not at all. I mean, I think our credit position, we've always been relatively conservatively positioned. We've had no impact at all. If anything, conditions in Hong Kong continue to improve. The business has had another good quarter, and we're seeing good IPO activity with some of the return of IPOs out of the US into the Hong Kong market.
Well, that's where potentially you, and I want to get your guidance, because, of course, US-China tensions are rising. That's very evident. And the Chinese authorities reaching in to regulate capital raisings. Are you bullish on your pipeline for IPOs and capital raisings, or should we be a little bit more measured when you see such heightened regulation?
I think there is some reason to be cautious, but we do think that activity levels in Hong Kong will continue to benefit from some of the tensions we're seeing at the moment between China and the US.
As a result of the market dislocations, you manage risk, you manage flow. Your job is to manage the risk book. Are you preparing to pare back any lending to any sectors, to tech, to education, to housing at all as a result of the moves?
Well, look, we always keep risk appetite under constant review. I think at the moment we're very comfortable with our credit books in China, and yeah, I think when you look at our lending books in China, less than 40% of our loan books are to state-owned enterprises. About 20% of the book is to international companies investing into China, and 40% of the book is to private enterprises in China. So we think we're reasonably balanced and we're comfortable with our risk.
HSBC CFO Ewan Stevenson there speaking to Bloomberg's Manus Cranny. And remember that you can follow the latest reaction to HSBC earnings on our T-Live blog. That's T-Live Go on your terminal. Now, we heard there the HSBC CFO telling Manus that the bank is still investing heavily in Hong Kong and China, and that it remains confident in the long-term macro trends in the region. Now, Ewan Stevenson's comments come days after Beijing's crackdown on private business ignited a $1 trillion sell-off last week. But China is now seeking more communication with the U.S. on overseas IPOs. In a statement, the country's security regulator has called for talks with the SEC, and that's after the SEC required additional risk disclosures for Chinese companies last week. Now, Beijing has also asked for mutual respect and collaboration on the issue. Well, let's get into the issue. We're now joined with Christian Keller, head of economics research at Barclays. Christian, good morning to you. Thank you so much for joining us. So we heard there from the HSBC CFO saying that, okay, we're still interested in China. Of course, we always look at our risk books, but they're not seeming to make any big withdrawals from the region. Would you say that's pretty characteristic of how most foreigners are now approaching China after the past few weeks?
I think it is. Let's take a step back. There was a lot of regulatory intervention, and some people call it a crackdown. Various things that Chinese authorities did. But if you take a step back, this is the second largest economy in the world. It has decided to open its capital account to some extent already for fixed income, also for equity. It's a very difficult economy to ignore if you're a global investor. And I think, the whole strategic onboarding of China as an asset class, that will continue. But I think what investors got a taste of in the last few weeks is, it is not the same as investing in, a U.S. equity market. This is not a fully free capitalistic, economy, and the government can be much more heavy-handed intervening. And so I believe investors may reorient themselves, but it's difficult to think that they would really withdraw from something that looks to be the market of the coming decades, really.
Yeah, fair enough. I mean, it kind of reminds me of what our Bloomberg opinion, Shuli Ren, said, that if you're very invested or you're very aware of these Chinese markets, perhaps you're in China, you weren't necessarily surprised by what happened. Okay, so you need to reorient yourself, perhaps, if you're an investor. What parts of the Chinese economy or corporations, perhaps, become more successful from this, even if sort of the big mainstay tech ones face that regulatory crackdown? Are there other elements of the economy that see a benefit from this?
Yeah, that's I think the crucial question. The Chinese authorities typically are quite strategic about these things. And what did they really? What was the message they wanted to send? And I think it was a twofold message. The one part of the message is they clearly want to have more control. And they want companies, IT companies including, to continue to raise capital, including in the US, through these various vehicles that exist. But at the same time, they want to control it. And second, and that what we believe was the more recent crackdown, in particular on the education and on this tutoring sector, they don't want too many resources to go into that part of the IT. We think they want to channel resources, continue to be in IT, but more into what they believe are the classical made in China sectors they want to boost. And that is IT, but it's more maybe software, but it's also electric cars and those things where they want to gain manufacturing leadership in.
Okay, so if that's some of the corporations, let's talk about the overall economic growth picture, Christian. We had PMIs a little bit softer. We had some noise from Chinese regulators or authorities rather, that the market seems to be interpreting as more accommodation to come. You had bond yields plummeting today in the 10-year space below 2.9%. Is that a fair interpretation that more support is on its way for the Chinese economy?
They started to indicate that they, with the first, for the first RRR cut, the PBOC that is, that they would be willing to support credit growth and, keep monetary conditions accommodative. If you listen to what came out of the Politburo meeting on Friday, even though there were not a lot of details. But in general, that was also a message whereby we could see some more fiscal support, be it through the issuance of bonds on the local side, but also we think in fiscal spending from the central government. All this is measured. I think the Chinese hold on to wanting to transfer the economy to slow growth path, but there will be more support.
Christian.
I think they've realized that they slow too much.
Christian, unfortunately, we're out of time, but you are going to stick around with us. We definitely have much more to cover. That's Christian Keller from Barclays. I also want to give us a quick check on some Deal Watch. Square announcing a monster deal to buy a buy now, pay later company, and it's called Afterpay. Those shares sinking more than 5%. Bloomberg Intelligence's Matt Ingram pointing out that investors probably not happy with this, considering the high premium that they are paying on this company. The deal total value about $29 billion. So we'll keep an eye on that for you as the market trading gets underway. Now, coming up, we're going to stick in the U.S., where the U.S. Senate is set to vote on a $550 billion infrastructure plan within a matter of days after finalizing the bill's text over the weekend. That's next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, a bipartisan Senate group wrapped up 6 weeks of negotiations on Sunday with a $550 billion infrastructure package they hope to put to a vote and pass this week. The bill would mark the biggest injection of federal spending on public works in decades. A major milestone for President Biden's economic agenda. We're joined now by Bloomberg's Bruce Einhorn, who's been covering this. So, Bruce, what is it, nearly 3,000 pages in the bill? I'm sure you've read it all. What are the big takeaways?
Yeah, I'm still getting to the final bits. So we're looking at $110 billion for roads and bridges, 70+ billion for upgrading the electricity grid. There's about $66 billion for railroad and Amtrak, which would probably make President Biden happy, a famous fan of Amtrak. There's also money for broadband, there's money for clean water, there's money for mass transit. So those are all the different pieces of the bill. And it does seem like we're going to have both Democrats and Republicans supporting this, which is very unusual.
So, okay, they both support it, but what does that mean for its chances of now becoming a law? Are they pretty high at the moment?
Well, nobody really thought well, not nobody, but a lot of people didn't think we were ever going to get to this point. But here we are. It looks like the Senate is going to vote and pass it later this week. Then it has to go to the House. Most likely the House isn't going to vote on it until after the summer recess. There's still a lot of, potential, obstacles that have to be overcome. So it is not a done deal by any means, but it's getting close.
Not a done deal. Bruce, thanks so much. That's Bloomberg's Bruce Einhorn giving us the latest on infrastructure. Let's get into the market and economic implications of this. We still have with us Christian Keller from Barclays. So, Christian, getting closer to passing this nearly $500 billion bill, what would that do to the inflation picture? Does this give fuel to the U.S. economy that perhaps it doesn't need?
First of all, this is positive news, and we have been ourselves, and we remain relatively skeptical with the deal coming through. But this seems to be having some impetus. We're obviously coming from numbers that were in the $4 trillion area. Now we are down to $500 billion, but obviously targeted towards what people would consider the real infrastructure part of it. I think it should help markets to gain some more belief in the longer-term growth prospects of the U.S. If you look at U.S. Treasury markets, they very much seem to be pricing in a return to pre-COVID times with regard to inflation, but also with regard to subpar growth. If I look at real yields in the U.S. now, below 1%, 10-year real yields, if you get that infrastructure package and you believe that really puts the U.S. possibly on a higher, medium-term growth trajectory, markets should actually adjust somewhat to that, including in higher real yields.
Yeah, I mean, they should adjust, but I just feel like this bond market has been confounding all of us in terms of the reaction it has to the economy at this moment. I mean, is the real yield at, I think it's about a negative 117 basis points at the moment. Is it reflecting the fundamentals, or is it reflecting the continued accommodation from an involvement from the Fed?
I think it's obviously always a bit of both, but on the 10-year, you should argue that it's actually to a large extent really expectations. Where do markets think, will the economy go over the next 10 years on average? And I think markets now have very much decided on a few things. I mean, A, they do believe that inflation is transitory. That's a very strong message from the data if we see the combination of real yields and nominal yields. And then they also seem to believe that even if the Fed hikes, we always look at when will they start? Will it be 22, 23? But for the market, it's very important also how much would they hike. And we look at Fed futures, they tell us that the Fed will only go to 1.25, 1.5 percentage points. That's a lot lower than a few years ago still, where markets thought the final rate of the Fed would be. The market believes here inflation will not come back, and all we're going to get is maybe 100, 150 basis point rate increases rather than 400 points or so that we saw in past cycles. And that is a very strong belief, I think, at the moment. It may take a lot for the market to get out of that.
Should the market be more waken up by corporations who repeatedly cite inflation? We had Heineken earlier today, that CEO talking to Anna Edwards, saying that they're going to see more costs up through 2022, higher costs rather. Should that factor more in at this moment?
I do think the market pricing at the moment, that the risks are asymmetric in the sense of there are more risk that markets have to adjust a bit. There are good reasons to believe that there are a lot of transitory elements in this inflation when it comes to car prices, et cetera. Those should fade out. But we have increasingly indications now that some of those supply bottlenecks, some of the cost pressures, as you mentioned just earlier from companies, that they could last into 22. And, I think that puts, in particular, we look at government yields, that puts pressure or risks on the upside, yields having to go higher, markets having to acknowledge that inflation may stay a bit higher for longer.
Nothing like a little bit of asymmetric risk on a Monday to wake you up. Christian, thanks so much for joining us today. That's Christian Keller, head of economics research at Barclays. Thanks again. Now, coming up, Goldman Sachs joins the Wall Street salary increase party. It's bumped up its pay for junior staff, but it goes further than a lot of its rivals. Who's going to follow suit, and will they follow suit? We discuss that next. This is Bloomberg.
Hybrid way of working is here to stay.
Our offices are evolving into more hybrid spaces, more flexible working.
It was accelerated because of the pandemic. It was already coming in.
We're prepared to have the flexibility to allow people to work from home 2 to 3 days a week.
Just saying 2.5 days, well, that's a simple thing to say, but you have to make sure that the teams can have a catch-up.
We've tried to keep our teammates, keep level balance, stay mentally healthy, stay physically healthy. And we think getting them back to work actually is a major part of that. So we're starting to bring those colleagues back.
Some activities don't lend themselves to working from home at all.
But there will always be a need for offices. There will always be a need for collaboration.
Banking executives there talking about the return to the office. And as some executives offer flexible working arrangements as an industry draw, others are turning to more traditional methods. Goldman Sachs, the big one at this moment. Over the weekend, we learned that Goldman has raised pay for its junior investment bankers. And though it's one of the last ones to do so, it has also beaten most rivals with its offer. So that means first-year analysts at the bank will now be earning $110,000. That's about $10K more than the pay hikes at Morgan Stanley, Citigroup, and JP Morgan. Now, Wall Street is hoping that its improved salary packages will stem defections and attract new talent amid record deal flow and ballooning workload. So a really important and consequential push from the investment banks here. Let's now, though, get to the first word news. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. The U.S. is blaming Iran for an attack on an Israeli-linked oil tanker off Oman that claimed 2 lives. Secretary of State Antony Blinken says there's no justification for the assault and warned of an appropriate response to come. His condemnation came after Israel and the UK also both blamed Tehran, though neither offered any direct evidence. Iran has denied all responsibility. Now, booster vaccines are to be offered to 32 million Britons starting early next month. That's according to a report in the Telegraph. All adults aged 50 and over, as well as the immunosuppressed, will be offered the jabs, with pharmacies taking the lead in delivering them. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you so much. So coming up, more communication. Chinese regulators seek talks with the SEC after the U.S. tightens rules for an IPO. We're live from Beijing next. This is Bloomberg. HSBC resumes its dividend after doubling profits. Its CFO tells Bloomberg the bank is still betting big on China despite Beijing's crackdown. Let's talk. Beijing wants discussions with the SEC over its decision to halt U.S. IPOs of Chinese companies. The U.S. infrastructure deal is done. Senators finished the text of the $550 billion package. Chuck Schumer says the bipartisan bill will be passed in a matter of days. Happy Monday. Good morning to everybody. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, and it is the first trading day of August, a month that usually everyone takes off on holiday. It gets volatile out there, but it is a constructive start to this month, and really it's the handoff from China that allowed us to move higher from here. Chinese equities ending the day higher by 2.5%. The bond market was on fire. You saw U.S. 10-year yields dip below 2.9%, so that means a stronger day both in Europe and your American future session. We are seeing small caps outperform in the U.S. with the Russell 2000 futures up more than 1%. Now, let's stick with the China story. And China is seeking more communication with the U.S. on overseas IPOs. Now, in a statement, the country's security regulator has called for talks with the Securities and Exchange Commission. That's after the SEC required additional risk disclosures for Chinese companies last week. Beijing has also asked for mutual respect and collaboration on the issue. Let's get more into this now with Bloomberg's China government reporter, Lucille Liu. So, Lucille, a lot of different developments to keep track of here, but specifically with the Chinese security regulator, what were they signaling with the statement they issued over the weekend?
Yes, I mean, the Chinese security regulator very much trying to ease market fears over Beijing's crackdown. It said that it's looking for a suitable resolution, which is better than obviously an escalation or retaliation on this dispute. So markets, of course, have taken well to this, and as you mentioned, are up over 2%. So the SEC basically wants more information, and so long as the Chinese side doesn't see these new disclosures as compromising national security, then there is room for the two to find a solution.
So as you say, it helped lift markets here, but what other attempts has the Chinese government made to help calm the markets?
Yeah, there's certainly been some discomfort with this $1 trillion route. And so we've seen state-backed media issue a series of articles suggesting that the route is overdone. We've also had analysts speculate that government-linked funds have been intervening to prop up the market. And just over the weekend, we had the official Xinhua news agency publish a commentary saying that Beijing should manage the balance between between listings and also security. So it's certainly trying to find a balance in the midst of this route.
Okay, and also Politburo meeting Friday. What are the key signals coming from that?
Yeah, so we saw that the Politburo say that it's going to offer more targeted support for small, medium-sized enterprises, especially with resurgent pandemic risks. Bloomberg economists have also noted that this idea of setting its own agenda is really very pervasive throughout the Politburo statement, suggesting that going forward, China is looking to strike out on its own path and suggesting that the People's Bank of China is less likely to take its cues from the Federal Reserve in setting monetary policy.
Lucille, thank you so much. A lot to go over there. Thanks for staying on top of it for us. That's Bloomberg's China government reporter, Lucille Liu. Now, China's manufacturing activity, along with all the politics, dropped by a bigger magnitude than economists had expected in July. The Caixin Manufacturing PMI, which captures sentiment of smaller private firms, dropped by 1 point to 50.3, signaling softer conditions at the start of the third quarter. The reading came in line with official readings released on Saturday. Let's get into both the economic story and the political story. We're joined by Diana Choileva, chief economist at Enodo Economics, a macroeconomic and political forecasting company that focuses on China. And Diane, I should tell all of our viewers that the firms you advise manage more than $10 trillion. So you have a very unique insight here that a lot of people do not have. How much aversion are you hearing about from your clients when it comes to investing in China at the moment?
The number one question really I hear is, has China now become uninvestable? How are foreign investors, with this clear-cut message from Beijing that they are last on the list of any concerns that they might have, value risk in the unique environment that China is for the foreign investor?
Okay, so what's your answer to that? Has China become uninvestable for the foreign investor?
Well, we changed our call on the Chinese equity market straight after the RRR cut to get out now. But at that time, that was a more short-term call over the next 6 to 12 months based on the whole deleveraging growth slowdown story. But after the most recent actions, this really is a call that I would extend to the next 2 to 3 years until it becomes clear how China would actually interact with the foreign investor, because we are in the era of the great decoupling, the bifurcation of the world economy, markets, politics into two spheres of influence, a Chinese one and an American one. And the capital markets are caught in that, very much so, and foreign investors that invest in China would be potentially, we can't discount the fact that they can be caught as pawns, if you'd like, in this great power competition. So it's an extremely difficult situation, and one which for the sort of immediate future, and by the way, that concerns more so our US and European clients on the European side as well, in particular, ESG concerns or considerations make China very difficult to assess, much less so in Asia, though, because that would be the natural sphere of influence that China would like to acquire, and the story there is somewhat different.
Okay, so if the foreign investor is kind of last on their list in terms of what they care about, what do you then make of China's efforts to reach out to the U.S. and open up the door of communication when it comes to IPOs? Is this not sort of a crack of light in terms of trying to accomplish a more symbiotic relationship?
Not really. If you see, you have to see where this is coming from. I mean, the CSRC is not the regulatory body that really calls the shots. Your commentator just before me gave you an account of the Politburo meeting and what came out of there. There wasn't a sort of strong message coming out of that meeting that they're reaching out anything beyond the usual words that they have employed in trying to deal with the US at the moment. I would say that to an extent, the Chinese Communist Party is kind of on the back foot at the moment, because any hope that they had with respect to possibly putting a floor under the deterioration in relations with the US under the Biden administration has gone out of the window. The Biden administration has been as tough, but much more experienced, well-organized, and as such more effective in the constraints that they're putting on China. So this is still very much all up in the air, and I don't see this as being resolved anytime soon, or any white flags on either side being properly raised.
Right. Okay. So, I mean, that's really fascinating. You know, it's going to take a while for us to figure this out. Don't buy the dip. But Diana, what do you do if you already have lots of investments in China? Are you also saying, okay, maybe it's time to re-examine those and pull those out? Or is it just not about adding on more exposure to the region?
Well, the Chinese equity market first has no relation to economic growth in China whatsoever over the years. It's very much driven, though, by domestic liquidity. And bear in mind that the assault on the education sector was very much as well a domestic hit to those businesses rather than just, totally disregarding the foreign perception of investors. So my advice would be that on any upturn that is engineered by domestic liquidity returning, the foreign investors should have a very clear assessment as to what their exposures are, which sectors, try and also determine how the risk-reward balance works out, and then exit anything that doesn't have a very clear exceptional return outlook for, I would say, within the sort of 2 to 3 year horizon. But even that's probably too far.
Diana, it's certainly a lot to think over there. Yeah. Diana, apologies. It looks like we're out of time. We definitely have more to cover. You definitely have to come back on with us. Diana, thanks so much for giving us your insight today. That's Diana Choleva, Chief Economist at Enodo Economics. Thanks again for joining us. Let's quickly look at the UK story. UK July manufacturing PMI is coming out. We've gotten a lot from Europe. Bang in line with the prelim number coming at 60.4. Of course, that's a very strong number. Slight move higher here in the cable rate. Not too dramatic. We're still under 1.4, but definitely a brighter picture of the economy. Will this change the BOE's hand? It is coming in online. We do have that BOE rate decision later in the week. Now, coming up, we're going to discuss banks. HSBC is paying an interim dividend and considering buybacks after quarterly profit doubles from a year earlier. More on our exclusive interview with the CFO, Ewan Stevenson, next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. Heineken, the world's second largest brewer, says it will sell less beer in 2021 than before the pandemic. That's because of the impact of COVID-19 in key African and Asian markets. This comes as the Dutch company posted first half profits that did beat estimates, but with a warning that rising commodity prices will weigh on the second half earnings. Now, Pfizer and Moderna are reported to have increased the prices of their COVID-19 vaccines in the latest supply contracts with the European Union. According to the FT, terms were renegotiated after clinical trial data showed vaccines from the two companies are more effective than some of their rivals. The new price for the Pfizer vaccine is €19.50, up from €15.50 before. The deal struck this year covers up to 2.1 billion doses until 2023. Now, Korea's LG Energy Solutions says it's planning to be carbon neutral by 2050. The world's second biggest battery maker also aims to convert the 100% renewable energy even earlier by 2023. The Seoul-based Tesla supplier is the latest South Korean company pushing to go green. And that's your Bloomberg Business Flash. Danny.
Leanne, thank you so much. On to HSBC, which is resuming dividend payouts and considering buybacks as the global economy starts to emerge from the worst of the pandemic. Our Manus Cranny spoke exclusively with CFO Ewan Stevenson about the dividend and the outlook for investing in China.
We're very, very confident we can hit that dividend policy this year. I mean, I think what we've seen so far this year is capital to continue to accrete into a much better place than where we thought we'd be at this point. Largely driven by credit outperforming relative to where we thought. But relative to 3 to 6 months ago, our capital position's a lot stronger. So we are adjusting our tonality today on capital distributions. We are signaling the fact that relative to the start of the year, where we would have said to you that we were going to continue to be cautious, I think now we definitely feel more confident, and we will keep buybacks under review in the coming quarters together with dividends.
$1 trillion was wiped off Chinese equities globally, from Hong Kong to onshore to the United States. Are you unscathed? Did you have any margin calls, any collateral impaired as a result of the wipeout?
No, not at all. I mean, I think our credit position, we've always been relatively conservatively positioned. We've had no impact at all. If anything, conditions in Hong Kong continue to improve. The business has had another good quarter, and we're seeing good IPO activity with some of the return of IPOs out of the US into the Hong Kong market.
Well, that's where potentially, Ewan, I want to get your guidance, because, of course, US-China tensions are rising. That's very evident. And the Chinese authorities reaching in to regulate capital raisings. Are you bullish on your pipeline for IPOs and capital raisings, or should we be a little bit more measured when you see such heightened regulation?
Yeah, I think there is some reason to be cautious, but we do think that activity levels in Hong Kong will continue to benefit from some of the tensions we're seeing at the moment between China and the US.
As a result of the market dislocations, you manage risk, you manage flow. Your job is to manage the risk book. Are you preparing to pare back any lending to any sectors, to tech, to education, to housing at all as a result of the moves?
Well, look, we always keep risk appetite under constant review. I think at the moment we're very comfortable with our credit books in China, and yeah, I think when you look at our lending books in China, less than 40% of our loan books are to state-owned enterprises. About 20% of the book is to international companies investing into China, and 40% of the book is to private enterprises in China. So we think we're reasonably balanced, and we're comfortable with our risk.
Upbeat dividend, the upbeat provisions, and the conversation you and I have just had. Can you and the team now re-accelerate the restructuring plans that you have? Maybe go a bit faster?
Well, I think we're going about as fast as we feel we can at the moment. I mean, in the last few months, we've announced the sale of our mass market retail business in the US. We've announced the exit of our French retail banking business. We're in the process of moving a bunch of staff, senior staff, down to Hong Kong. Our investment program is running at about as fast as it can for the capacity that we've got to execute at the moment. So we're on track. We're running as fast as we can.
Manus Craney there, speaking with HSBC CFO Ewan Stevenson. And the man of the hour joins us now. Manus, great interview. I thought it was really fascinating, sort of as you put it in your conversation with Ewan Stevenson, the upbeat tone. How bullish would you characterize what Ewan told you on both growth and the dividend for HSBC?
I was surprised with just how sort of stoic and robust his commitment was to the upside growth story, because the IMF has actually downgraded Asia and India. India was the biggest downgrade to growth. But Ewan sounding absolute resolute. Hong Kong, mortgages, property market, I'm paraphrasing, he didn't say on fire, but very strong. Likewise in the UK. I've had a couple of hours to listen to Ewan's conversation again with me. And really what comes to mind is a CFO which remains unbowed, an institution that is at this juncture unscathed by the $1 trillion wipeout, and absolutely not under any pressure. They're recommitting to Hong Kong. They are, at this juncture, not assuaged by the regulation, the long arm of the Politburo. And I love the word that Ewan used, the tonality, the shift in tonality, the shift in the growth perspective, the shift in the dividend, the shift in the buyback. And again, there are breaking news headlines coming across the Bloomberg terminal as we speak from Noel Quinn, the CEO. He is saying we will use buybacks to normalise the excess capital. The bank sees significant liquidity in Hong Kong. So again, a really, really strong message from Ewan, Danny, about absolutely no sign of any quavering or wavering in the positioning in China and in Hong Kong, despite the geopolitical angst.
Yeah, fascinating. A lot of foreign inflows did not necessarily behave the same way. Manis, I know you're going to stay on top of the HSBC story for us throughout the rest of the day, and we'll continue to bring you chunks of that interview as well. That's Bloomberg's Manis Graney. Thanks so much for coming to join us. Now, coming up, Jack Dorsey's Square splashes out on its biggest deal ever, spending $29 billion for Australian buy now, pay later platform called Afterpay. Square, though, falling in pre-market. Why exactly? We have the details for you next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, Jack Dorsey's digital payments platform Square has agreed to buy Australian company Afterpay for $29 billion. The deal for the buy now, pay later company is Square's largest ever acquisition. It said that the purchase represented a chance to capitalize on a shift away from traditional credit, especially among younger users. Joining us now to discuss this is Giles Turner, our TMT managing editor. So, Giles, the reaction, at least on the Square side, not necessarily the most positive one, dipping in pre-market trading down more than 3.7% rather. Why? Is the deal just too expensive?
Yeah, I think there's probably a bit of a fear from investors that they're going to have to up this deal because relatively Afterpay was actually trading quite a lot higher than this earlier on in the year. So even though this is coming as the biggest Australian deal ever, which if you think about it is crazy given the infrastructure in the country, I still think investors are going to think maybe there's a risk for a bump. And maybe this deal isn't quite right for Square because it is a very, very expensive deal. Afterpay, you get a fifth of Square shares, for example, and that's quite a sizable chunk.
So it might not be right for Square, but what about on the Afterpay side? Some of the Bloomberg intelligence analysts writing that it might reject the deal. Why might it reject that Square offer?
I think it's just simply down to the share price. I think the shares are trading much higher for Afterpay earlier in the year. There's also a case of all these buy now, pay later companies. They've been rising incredibly during the pandemic, mainly because consumers are stuck at home. Younger consumers are stuck at home. They usually be out spending their money, perhaps on going out. Now they're spending their money online. So all these companies are doing incredibly well, like Klarna, for example. So they're seeing increased competition, and maybe they think, well, even though this deal is huge, maybe Square have to pay a little bit more.
Yeah, fair enough. Giles, thanks so much for keeping track of this deal for us. Certainly a lot of deal flow happening in the TMT space. Our thanks to Giles Turner, TMT managing editor. And a quick check on markets. Certainly a more constructive day. We're seeing equities move higher across the space, be it in the U.S. or Europe, getting that bump after the CSI 300 closing up more than 2.5%. We'll continue the market conversation next in Bloomberg Surveillance Early Edition. Matt Miller and Kaylee Lyons join me out of New York. This is Bloomberg.
Our investment program is running at about as fast as it can for the capacity that we've got to execute at the moment. So we're on track. We're running as fast as we can.
Our offices are evolving into more hybrid spaces, more flexible working, but there will always be a need for offices.
We obviously aim to hire the best talent. To do so, we have to pay competitively.
This is Bloomberg Surveillance Early Edition with Francine Lacqua, Matt Miller, and Kaylee Lyons.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Monday, August 2nd. Our top stories today: Goldman Sachs gets on board. It becomes one of the last big Wall Street firms to raise junior bankers' pay. A Square deal. Jack Dorsey's digital payments platform will pay $29 billion for Australia's buy now, pay later company Afterpay. And on the verge of a vote, the U.S. Senate is closing in on a likely passage of the infrastructure bill this week. I'm Danny Berger in London alongside Matt Miller and Kaylee Lyons in New York. Francine off again this week. Kaylee, to start your August, it seems like a very buoyant equity market, maybe not exuberant, but the handover from Asia certainly seems to be constructive.
Yeah, green all across the screen on this Monday morning, Danny, and that did start in the Asian session. Concerns about that regulatory crackdown in China really do appear to be easing. The Nikkei was one of the outperformers, up 1.8% in the Japanese session, and the CSI 300 in China up about 2.5 percentage points. What's interesting, though, is you are still seeing a bid into the Chinese bond market. The Chinese 10-year yield down about 3 basis points. 2.82% is where we sit, which is the lowest in more than a year. So that still reflects some concern about a slowdown in growth. We did see activity decelerating in July, that PMI read coming over the weekend. Plus, there's still concern out there about the Delta variant and a worsening COVID-19 outbreak in China and in Southeast Asia as well, including in Thailand, where restrictions are tightening, covering about 40% of the population. And as a result, the Thai baht is a big underperformer in Asia today, weaker against the dollar by about 0.2%. Here in the U.S., green across the screen as well for the equity market. Futures are pointing to a firmer open. Right now, we're up about 0.6% on S&P 500 E-minis. In the bond market, you are not seeing a bid for safety. In fact, selling in treasuries. We're up just about a basis point on the 10-year yield to 1.23%. Crude, though, under a little bit of pressure, probably concerned about the Delta variant and what it's going to mean for demand. So WTI down about a percentage point to $73 a barrel. And then finally, I just wanted to note Bitcoin. It rose about $41,500 over the weekend. Maybe a little bit of profit taking now, though, Matt, because it's back below 40K.
All right, very interesting stuff. We have green on the screen in Europe as well. If you take a look at the map, you can see pretty much everyone's doing well. There are some outperformers. Spain up 1.4%, the FTSE MIB and the UK both up about 1%. But generally, almost everything is on the rise, and there's really strong breadth as well. If you take a look at the bunds, you can see they're gaining a little bit back above negative 45 basis points. The pound right now trading at 139.17. Not a lot of movement there. You're seeing gains in the pound, gains in the euro, but that's really about dollar weakness. And then Allianz is one of the big underperformers, down 6% now, saying that a probe into its funds could substantially affect earnings. So investors are watching what's going on with Allianz in Munich. Danny?
Yeah, Matt, look, it's certainly interesting when it comes to insurers. The risk of COVID is there. I spoke to AXA earlier today, who said that they're negotiating payouts with French restaurants over COVID policy. It's certainly weighing on companies throughout this earnings season.
Yeah, well, of course, this is a slightly different story because the probe is into a fund and not any concerns about insurance. Remember, Allianz owns a bunch of fund managers, including PIMCO. So it's a different issue than insurance risk.
Yeah, but look, insurance risk definitely on the horizon for these companies, and this just adds to it as well. Well, let's take a look at what's on your horizon for the week. We get U.S. ISM manufacturing data. That's out at 10 a.m. New York time today. Tomorrow, Alibaba, its first quarter earnings results are released. Of course, big China companies listed in the U.S., certainly a concentration for all of us right now. And Thursday, all eyes on the Bank of England for its latest rate decision. It's expected to keep things unchanged. And then Friday, the U.S. July jobs report is expected to show another robust month of hiring. Now, sticking with the U.S., where Goldman Sachs joined its rivals on Wall Street by boosting pay for its junior investment bankers, first-year analysts will now earn at least $110,000. Let's get more into this with Marcus Ashworth, Bloomberg opinion columnist. Marcus, is it fair to characterize Goldman as the last domino to fall when it comes to boosting junior pay?
Possibly, but I think is that they were the least ones that had to worry, because you want to join Goldman because you know it's not about the basic salary, it's about the overall comp and getting to the elite partnership status at some stage in your career, hopefully. So, I mean, what's happened here is that Goldman, like the rest of them, have been forced to pay a higher option price to try and find the same type of people. And the ones that maybe they want are the ones that are not that excited by an extra $10,000 on top, because they may want to set up their own startup. They may want to go join Amazon or Google or go to venture capital or private equity. So in some senses, it's just catch up. And then Goldman were reluctant to do it first, and that's why they've done it last.
Yeah, these banks are no longer only competing against banks for talent, Marcus. And of course, we got other banking news this morning. HSBC will pay an interim dividend after reporting profit that doubled from a year earlier. We spoke with the CFO earlier today on Bloomberg. Take a listen.
we're very, very confident we can hit that dividend policy this year. I mean, I think what we've seen so far this year is capital to continue to accrete into a much better place than where we thought we'd be at this point.
So, Marcus, we have this interim dividend. Given the results we got out of HSBC, how does its position compare to its peers?
Well, it's in a rather parlous state, HSBC. It's a huge behemoth, and really the only reason why it's able to pay its dividend, and it needs to pay a dividend to attract its stable type of investors who look at HSBC as a nice, safe, boring play, is because it's released a whole bunch of reserves. Because it held back an awful lot for good reason throughout the pandemic crisis. It's now being able to release a lot of that back in, which is the reason why its profits are up, reason why it can pay a dividend. However, its underlying business is actually on the slide. Marginally, doesn't really matter, but their tilt towards China is a big long-term play, and that is a far more important risk factor for people who want to buy HSBC shares.
All right, Marcus, thanks very much for joining us. Bloomberg's Marcus Ashworth on the banks. Now, let's get into tech. Jack Dorsey's digital payments platform Square has agreed to buy Australian buy now, pay later company Afterpay for $29 billion. The deal is Square's largest acquisition ever. Let's get more on the story with Matt Ingram, Bloomberg Intelligence senior industry analyst. So it's a big deal, and it's a different direction really for credit, not what you would traditionally think of as loans or cards, but rather this kind of new, not new, but hot buy now, pay later space, right?
Morning all. Look, it's kind of new, but not new, as you say. It's kind of like an old school lay-by that people would have done in past generations, where the largely millennial consumers, but not exclusively, can spread their payments over several fortnights, and they see it more of a savings plan. So, yes, there are no exorbitant interest rates. Yes, there are minimal fees, particularly for Afterpay. It's a booming space within payments, and I think that's because the millennial generation really trusts this product. So absolutely, Square is buying into a growth area, but certainly not new.
Matt, but Square shares pre-market falling more than 4%. Why? Why don't investors like this?
Look, our comment this morning from an Afterpay perspective was actually quite positive for Square. So that's an interesting reaction from the market. We actually made the comment this morning that it was Afterpay shareholders that may not be so keen on the deal. We think they're buying excellent growth. Square is buying excellent growth. Square is picking up Afterpay at a 20% plus discount from where it was in March. They're picking up global footprint, which they certainly don't have in the US. And they're picking up the critical missing piece in their platform. PayPal's already launched their Pay in 4 product, which is an Afterpay type product. Square can plug that in pretty easily with a really good 16 million customer base. So we think Square is buying a pretty good asset.
All right, Matt, thanks very much for joining us. Matt Ingram there, Bloomberg Intelligence senior industry analyst on this big deal. Now, an even bigger deal, the U.S. Senate is on a path that could lead to a vote this week on a $550 billion infrastructure package. Senate Majority Leader Chuck Schumer announced that negotiators finished the text of the bill yesterday, which is obviously a crucial step towards eventual passage.
In the end, the bipartisan group of senators have produced a bill that will dedicate substantial resources to repair, maintain, and upgrade our nation's physical infrastructure.
Emily Wilkins, Bloomberg government congressional reporter, joins us for more. So, Emily, how soon until this actually gets passed?
So in terms of an actual vote in the Senate, we are looking at this week. We did start seeing the text last night. Going to be keeping a very close eye on senators today as they read through those 2,700 pages and try and see if there are any major outstanding concerns at this point. But you're hearing a lot of confidence from the group of bipartisan negotiators on being able to get something done here. Now, of course, the giant asterisk in all this is that even if the bill does wind up passing the Senate this week, we're not quite quite done yet. It'll then go to the House, but Speaker Nancy Pelosi has said that it will not be getting a vote in the House until the Senate goes ahead and sends along the Democratic-only $3.5 trillion reconciliation package, which has yet to be negotiated or passed in the Senate. And so you're kind of looking at the balance between these two bills, if there will be enough pressure in the House to maybe get the infrastructure package through before the other package. Progressive Democrats have said they won't vote for it in that case. A lot of negotiation left to do before either of these bills come before President Biden's desk for his signature. So we're still very much in the process at this point. And at this point, too, the House is gone. We're supposed to be not back until September 20th. We'll see what happens there. And the Senate is supposed to begin recess at the end of this week.
Another focus on Capitol Hill, Emily, is the eviction moratorium, which expired over the weekend, and no action yet from Congress on a fix for that. Millions of people potentially now facing the loss of their home. Nancy Pelosi has asked the Biden administration to extend it to October 18th. She also said the CDC could extend it as well. Are we likely to see either of those things happen?
That's such a great question, because the White House actually said that they could not do the extension and asked Congress to do it late last week. Unfortunately, or fortunately, depending on what your perception is here, the House did not have the votes to pass the bill. Some Democrats, moderate Democrats, had concerns about the legislation, about extending it, what that would mean for landlords. They did not give their support to the bill, wasn't able to pass the House, wouldn't have been able to pass the Senate. So at this point, in terms of expansion, Congress isn't going to be able to do anything. That's why you're now seeing Speaker Pelosi go back and say to the administration, hey, we're going to need you to try to extend the deadline, but that's something the administration has already said they cannot do.
All right, Emily Wilkins of Bloomberg Government, thank you so much. I do want to get back to the markets now and take a quick check on some stocks moving in pre-market trading here in the U.S. And of course, we were talking about that Square Afterpay deal. It is lifting shares of another buy now, pay later company in pre-market trading. That is Affirm, one of your big outperformers in early hours, up about 5.3%. Another stock moving to the upside is Novavax. Of course, it's a late comer to the COVID-19 vaccine game, but now that there's conversation around booster shots, it actually could see a real need for its inoculation. That stock up about 2.6%. And finally, Carnival Cruise Lines is also moving higher. Its Princess subsidiary completed its first cruise over the weekend successfully since voyages were halted because of the pandemic. That, Danny, was a cruise to Alaska, something I have always wanted to do. That stock higher by 3% in early hours.
A cruise to Alaska. Man, well, we know what else Kaylee needs in terms of present. No Cartier bracelet. Get this girl on a cruise to Alaska. Kaylee, thanks so much for that. And we're going to discuss a lot of those type of reopening trades and what it means for the economy coming up next. We're going to be talking with Simon French, Panmure Gordon chief economist. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons in New York. Danny Berger is in London. Francine Lacqua is off this week. I just want to take a quick look at what's going on in China compared to what's happening in the rest of the world. We've seen a sharp drop in the discount, or I guess a gain in the discount is what this really means, because these numbers are down below zero. I'll welcome, by the way, our listeners on London DAB digital radios. I do every day when I'm walking you through charts, because obviously you can't see them. But the point is, we're looking at the MSCI China Index minus the world PE spread, and it is getting worse, as you'd expect. Not quite as bad as it was in March of 2020, but the scare that has gone through financial markets after the clampdown on industries from ed tech to ride sharing has really kind of freaked people out. And the question is it going to get any better at this point? Joining us now on set is Damian Sassower, Bloomberg Intelligence Chief Emerging Market Strategist here. So, Damian, thanks so much for joining us early this morning.
My pleasure.
Let me ask you, first of all, have we seen the worst? Is the worst behind us in terms of this?
I think it's a great point, Matt, about the valuation discount. But if you listen to someone like Kyle Bass, he's going to say, don't believe the numbers coming out of China. And there's some truth to that, but that's all we can hang our hat on. If you look at the PMI data overnight out of China, right? A little bit weaker, But the fact of the matter is it's all about supply bottlenecks. You're going to see German factory orders this week. You saw South Korean exports over the weekend. It's all about supply bottlenecks. The demand is there, but what's causing all of this inflation and this reflationary scare is the fact that you just can't meet it.
So does that mean the PBOC can just sit back and watch here?
Well, they would like to, but I don't think they can in the markets. And I think that's why equity markets are up overnight, is the fact that, hey, the markets are pricing in more policy easing by the PBOC. You saw the 10-year in China down to 2.8%. I think that's the lowest in some time. So look, for me, as a guy who likes to receive in the front end of places like China, I'm an emerging markets guy. As you know, Matt, I mean, the trade is still there. The bet is still on. I think, though, on the equity front, there's a lot to be concerned about, and Kyle Bass is right on that front. It's very difficult for a fiduciary to justify an investment into China with the limited access that you have.
Damien, you're also a credit guy. I mean, looking at the credit sector, does China's willingness to help contain some of the equity market damage, does it mean that they also might be more willing to help some of the credit issues and stop companies from defaulting?
Well, Danny, now you're right in my wheelhouse. 25% of all emerging market dollar bonds trading above 7% come from China. And here's another one for you. 2/3 of all of the emerging market distressed debt universe, Chinese issuers. So you're absolutely right. There's definitely, and I think defaults now, I think just this morning we found out that defaults are at their highest, on record in 4 years. So look, there's a lot of issues in China credit. There's going to be more credit extended, I think, over the coming months. I think that's certainly what our economists are calling for. I think you're probably going to see some more rate cuts in the future, maybe not this year, but certainly that's what markets are playing for.
Why does China seem to be unfazed when it comes to the way global investors look at their markets?
Great question. 3 different China stock market bubbles that blew up in the last decade. The first one, the market was down 70%. That was back in 2015. Then the RMB devaluation down 40%. And then the trade war down 30%. In all 3 instances, it was the yuan that drove a lot of those losses. The yuan's been very stable this time around, so the losses haven't been nearly as extreme. If the yuan starts to fall out of bed, all bets are off.
Well, Damien, as you said, you're an emerging markets guy. So what's the spillover risk here to elsewhere in EM?
It's all about reflation, right? Well, the 2 big themes in emerging markets now that the markets are trading on are reflation and vaccination, right? So you're sort of seeing finally this dichotomy between the haves and the have-nots on the vaccination front. Countries like India, Indonesia are underperforming. But certainly on the reflationary front, that's all China. The fact that they can't meet this demand, that there are supply bottlenecks, that they can't assemble, whatever it is we're buying abroad, that is really the key point here. And we have a lot of inflation prints coming through this week. We have Brazil, we have Turkey. Yeah, I expect to see inflation going up, and I expect more rate hikes out of emerging markets coming through.
What about more of a contagion in emerging markets? In terms of just technicals, Mohamed El-Erian pointing out that China is a big chunk of the EEM ETF. Are we going to see a lot of out withdrawals because of factors of how just present China's become in a lot of passive indices?
Yeah, I mean, look, I've long been a fan of active investment in emerging markets. You got to pick, your spots there. You can't just blindly go into it because, as you rightly point out, these are illiquid markets. They're inefficient. And to just go in blindly is not the right trade. So I agree with Mohamed El-Erian for sure. I mean, I think China's spillover, I think they're 33% of the MSCI Emerging Market Index you're referring to. And that's a big number. So as goes China, as go Alibaba's earnings tomorrow, so go the rest of the emerging market equity complex.
All right, Damien Sassower of Bloomberg Intelligence up very early for us in New York this morning. Thank you so much. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Danny Berger in London. Francine Lacqua is off again this week. Now let's get the first word news. And Minneapolis Fed President Neel Kashkari warns that the spread of the Delta variant of coronavirus could slow the labor market's recovery. Kashkari told CBS it could keep some Americans from looking for work. He says the U.S. is about a third of the way back from where the hole was in December. The U.S. has formally blamed Iran for a deadly attack on an Israeli-linked tanker off Oman. Secretary of State Antony Blinken says there will be a, quote, appropriate response. U.S. Navy experts say they believe the ship was struck by a drone, killing 2 crew members. Iran has denied responsibility. North Korea warns that upcoming U.S.-South Korean military drills could jeopardize talks between the 2 Koreas. That raises doubts about a diplomatic breakthrough less than a week after both sides announced that communications would resume. Kim Jong-un's sister said the plan to hold annual allied exercises seriously undermines efforts to restore ties. And Japan and the UK reportedly are considering booster shots for coronavirus. According to Nikkei, the Japanese government may urge those who are fully vaccinated to receive a third shot next year. In the UK, the Telegraph says authorities are set to deliver booster shots to 32 million people starting in September. And Matt, I wonder when here in the U.S. we're going to start seeing a booster shot effort as well, considering places like Florida are reporting record cases at the highest point of any time during the pandemic.
Yeah, well, and the fact that we're seeing, half of those infected in Israel have been fully vaccinated, it's kind of starting to freak me out. I was going into a Duane Reade the other day, and I thought about just getting another shot. Is that?
Yeah.
I guess the booster is going to be more
Matt,
complicated.
You're not there yet, though. You have to be a certain age to get the booster shot. Luckily, all of us too young there, Kaylee, to finally get that third one.
All right, well, coming up next, we're going to talk about coronavirus and what the Delta variant means for the economic recovery. Simon French, Panmure Gordon, chief economist, will be joining us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Matt Miller and Kaylee Lines in New York. Francine Lacqua is off this week. Matt, it's all about the green today, not the green in the market, which, yes, up arrows are pointing higher, but moving to greener areas. It's the trend we're seeing in London. 60,000 people who live in the city bought homes in the suburbs. According to Hamptons, that's the highest amount ever.
Yeah, it does seem like everyone wants to get out there, and I completely understand it as a fan of, backyards and your own garage myself. One thing I've noticed, though, looking around here in Westchester or New Jersey or Long Island, the traffic is much worse than it previously was, because not only are people moving to the suburbs, but they're avoiding public transportation still.
Yes.
And as a result, it's unbelievable in New York. I'm sure London traffic is just as bad.
Yeah, and there are scooters and bikes everywhere, which I'm into. But yeah, it is a trend that is very much so indicative of our times, Kaylee. And I guess the times also, as I said, market's moving higher.
Yeah, well, I will be staying here in Manhattan, taking the subway, so I don't have to deal with traffic or drive a car. As for the markets, yes, they are higher on this Monday morning, Danny. A very positive start to the week that began in the Asian session and is following through in Europe and the U.S. In Europe, the Stock 600 higher now by about 0.7%. And here in the U.S., we do look set for a stronger open in about 4 hours' time. S&P 500 futures up also by about 0.6%. Therefore, no real need for safety. You are seeing selling in the bond market. The 10-year yield on Treasuries up just about a basis point. 123 is where we sit, and it is a weaker dollar story broadly in the G10 space today. As for some movers in pre-market trading, it is a merger Monday in the case of Square and Afterpay, Australian buy now, pay later company. That company surged 30% in Australian trading. Square, though, the acquirer, is down about 3.5% in pre-market. Investors don't seem too enthused at this point about that deal. It is, though, giving a lift to Affirm, another buy now, pay later company, which is higher by 6.5% in early hours. And finally, amid concern about the Delta variant and conversation about potentially booster shots being needed, we are seeing a lift to some COVID-19 vaccine makers. Novavax up 2.6% and Moderna by about 2 percentage points, Matt.
All right, well, I'm looking at inflation. Transitory may prove to be 2 or 3 years. These are the break-evens here. You can get them in the Bloomberg by typing ILBE GO. And if you're listening on London DAB digital radio, let me just tell you, they continue to climb higher, and they stay higher further out as well. So the question is, what does transitory mean? Is it only 3 months or 6 months, or is it 3 years? Joining us now is Simon French, chief economist at Panmure Gordon. And Simon, I guess the question isn't just how long does this inflation last, but what kind of effect does that have on people's spending?
Yeah, so I don't think anybody who's in the transitory camp, if you like, expected this to be a matter of a couple of quarters. I think there are always going to be, when you get a surge in demand, a push up in prices of this ilk, you'll get some echo effects that will pass through automatic pay settlements, automatic feed through into prices that are tied to inflation indices that will echo through for a year, 2 years. I think The real debate, if you like, is between those people who see this as a regime change back towards the kind of inflation rates that we were more familiar with 20, 30 years ago or not. And that's why I think that's probably the defining parameters for this debate. In terms of what it does to consumer spending, I think there is a very good question here as to whether the additional amount of savings that have been accrued across large parts of the developed economies get drawn down if households, anticipating that the cost of living may be somewhat higher down the track, may want to hold some back to be able to fund that.
So, Simon, speaking of the consumer, how do you think the Delta variant could cause some hiccups in this recovery, both in terms of the consumer kind of going out and spending and then also what it means for the labor market?
Well, in terms of consumer spending, we've always been a little bit cautious that going into the Northern Hemisphere winter, we weren't going to see economic momentum held at the kind of levels we're going to see throughout the summer. There will be a seasonal impact. It'll be difficult to disentangle that between the normal pressures you sometimes get on healthcare services. It'll be the first time with a widely vaccinated population that will go into a winter period and trying to understand how different variants may beat both the original vaccine and any booster system. So I think there will be some consumer caution. But, I think this is the real challenge for households to try and go, we have accrued out of restrictions to our consumption behavior this pot of cash. At what point are we going to use that to fuel the kind of economic recovery that would mean that monetary policymakers can take their foot off the pedal, which is firmly to the floor at the moment?
So if I can take that idea of consumer spending, maybe getting more hesitant in the winter months, what does that mean for corporations who have been able to keep their margins high because they can pass along costs to consumers? Does that then fade as the months go on here?
So that's the question, Danny. I'm pleased you asked it, because I think what you've seen in large parts of the consumer economy, particularly the goods economy, the tangibles economy, pricing power being introduced, which we think is temporary, the power given to both workers in those sectors, but also suppliers in those sectors. I think that starts to ease, and therefore, really in terms of your asset selection, your corporate margins, it really depends which side of the ledger. A lot of companies have benefited from those blowout margins, the ability to supply into a marketplace where there's demand that has been diverted from the services-based economy. The real question is whether, if you get additional consumer caution, whether that pricing power feeding into a strong demand picture starts to be impaired. There will be winners and losers. It won't be a single macro story.
Are we going to see, companies continue to invest, continue to spend? We talk a lot about retail investing and spending, but CapEx is obviously key as well for the economy.
It is, and I think we're starting to see the politics coalesce around a Build Back agenda, which isn't just going to be supported by the public sector balance sheet, but is trying to incentivize corporates, which I think there's a bit of a misleading story out there that they've accrued similar cash resources to households. It's not entirely true. I think what you've seen is households deleveraging and accrue cash. The corporate side, they've accrued cash, but they've also accrued liabilities, at least at a macro level. So there will be some incentives required to try and encourage corporates to go out and boost CapEx to try and buttress what will be public sector spending, but this required a kicker. They want this to crowd in from the corporate sector.
Right.
It isn't going to happen automatically because the balance sheet position isn't balanced.
Well, talking about public sector spending and government stimulus, we are making progress toward that $550 billion bipartisan infrastructure package. Could get a vote on Capitol Hill this week. How do you factor in that long-term economic spending when thinking about the trajectory of the U.S. economy?
Yeah, two parts to that. First of all, in terms of its impact on inflation, negligible, certainly near term. Anybody who's been involved in infrastructure programs knows that either physical shovels in the ground or metaphorical shovels in the ground come with a 18-month, 2-year lag minimum, and quite possibly longer than that. So in terms of the really feverish debate around the near-term inflationary impact of stimulus checks, this isn't going to be additional. But the economic story here really is about capital deepening. It's about the long-term productivity story of the U.S. economy. I think any analysis, I struggle to see any analysis that says that there's been sufficient capital deepening in the U.S.'s physical infrastructure. And therefore, if this unlocks that kind of investment, then the productivity gains down the track, albeit we may be 5-10 years away from them, should be material and should be very welcome.
Right. Simon, great to catch up with you this morning. That's Simon French, Chief Economist at Panmure Gordon. Now, coming up, concerns mounting about the Delta variant's continued spread. We'll have the latest on the virus next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an exclusive interview with Mazda Motor North American CEO, Jeffrey Guyton. This is Bloomberg.
If you do get infected, the likelihood of your getting a severe outcome of the infection is very low. It is much more likely that you will be either without symptoms or minimally symptomatic. So the vaccine is doing what you want it to do. It's protecting people from getting sick.
Anthony Fauci, U.S. National Institute of Allergy and Infectious Diseases Director, speaking on CBS Face the Nation yesterday. Joining us now for more on COVID-19 and vaccinations is Sam Fazeli, Bloomberg Intelligence Senior Pharmaceuticals Analyst. So, Sam, Dr. Fauci says the vaccines are doing what they need them to do. The question is, how long do they do that? Do we know yet when the threshold is that you're most likely to be not as protected and therefore be one of those breakthrough cases where you're vaccinated but then test positive again?
Yeah, hi, Kaylee. So I think the issue here is that it's not just how long you're protected for. Even if you just had your vaccine, there is a risk that you could catch an infection. We've always known they're not 100% effective, even when we were testing them against the other previous versions of the virus. So what data has just come out of Singapore seems to suggest that people who catch it, even if they're vaccinated, at the beginning, in the first few days of an infection, have the same amount of virus in their nose or in their respiratory passages as unvaccinated people. So you're as much of a risk. But what happens is that you clear it much quicker if you're vaccinated, and your disease is much milder. So, of course, add on top of that, if the vaccine efficacy, effectiveness against mild infection wanes over a few months, then, of course, that becomes a bigger and bigger problem.
How long until we have to wait to get a booster, Sam? And is there any difference between a booster and the regular shot, or is it just getting a third shot of whatever vaccine you started out with?
Yeah, so that's still a little bit unknown. I mean, Pfizer very clearly stated and has shown data that when you boost or when you give a third shot of exactly the same vaccine, you get a much higher neutralizing antibody, even against the Delta variant, though it's the same vaccine. So what that's telling you is that the current antibodies that this vaccine generates are capable, and we know that already because we're getting very few so-called breakthrough infections, right? But the question is, does that continue to be the case if you're getting a lot more Delta? Would you, if you gave a third shot that was representative of the Delta variant, would you get an even a better effective result? And we just don't know the answer to that.
So, I mean, what do you do then when you're trying to calculate risk in terms of going to events? I know a lot of West End shows, for example, here in London are asking, do you have a vaccine or have you tested negative? Is that enough confidence to say, okay, I can go to these events, they're indoors and I'll be fine? Or do we not know enough yet whether you can go and be confident you won't have a breakthrough infection?
Yeah, I mean, frankly, and I've been saying it all along, and people weren't so happy about me saying it, but I think it's now becoming pretty much accepted. If I were to do that in an indoor space like a theater, even though I'm fully vaccinated, I would still wear my mask. It actually does absolutely nothing to prevent me from enjoying my day there, but also adds a layer of protection beyond the vaccine. So why would I not do it? So that's the key first point I would say. Is that, and then, of course, a test, and that's the other element of it, a test only tells you whether you were infected or at a level that was detectable the day you did it. it doesn't tell you whether you're actually infectious the moment you walk through the door. I'm not so convinced that just having a negative test is enough for that purpose.
I know we're all thinking about Lollapalooza, by the way, so I will mention that Lollapalooza was considered to be successful in Chicago. That was, you know, you had to be vaccinated or have a negative test, and that was outdoors. I'm wondering about the risk of serious illness, Sam. If I'm vaccinated fully, but get the virus, what are the chances that I end up with serious respiratory problems? I think that's one of, the biggest concerns for the vaccinated.
Yep. Not very high. Let me read off some numbers for you. Unvaccinated, this is all against Delta. 74% had a fever, 40% vaccinated had a fever. Shortness of breath, 13% unvaccinated had shortness of breath. Only 1.4% of the vaccinated had it. The only thing that went up if you're vaccinated was a runny nose. I think we can manage that. Then another one, pneumonia. 53% of the unvaccinated got it, 21% of vaccinated. Oxygen requirement, 21% of unvaccinated, 3% of vaccinated. And the best, cherry on the cake, ICU admission, 5.4% of the unvaccinated with the Delta infection, 0% with vaccinated. This is what we want to see. But of course, our world is focused on mild infections at the minute.
All right. I'm just sort of running those numbers through my head and trying to figure out what I can deal with.
You'll get them hopefully in a note. I'm just getting through editorial.
All right, excellent. So I look forward to reading your work. Sam, thanks so much for joining us again. Bloomberg Intelligence's Sam Fazeli talking to us about the latest as we see continued spikes in the Delta virus. Coming up, chip shortage setbacks may last for the car industry into next year. That's according to the CFO of Ford, John Lawler. More next from our interview. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Danny Berger is in London. Francine is off this week. Ford says it sees the chip shortage potentially extending into 2022, but raised its full-year forecast anyway thanks to a surge in pricing for models that are becoming hard to find. The CFO, John Lawler, gave Bloomberg his outlook.
What we see happening for us at Ford, the chip crisis was a disproportionate issue for us in the second quarter. One of our key suppliers in Japan had a fire at their fabrication facility, and that shut down production in the quarter. And 70% of the volume that we lost, more than 70% of the volume that we lost in the quarter was due to that. They're up and running, so we will have those chips flowing to us starting this quarter. All in all, though, we're seeing a 30% sequential improvement in volumes through the third quarter into the fourth quarter. But again, you know, this situation is opaque. We're managing it week to week, day to day. And, you know, it's something that we're going to have to deal with through the rest of the year and potentially into 2022.
Of course, John, there are the things that are a little hard to come by these days that when you start building EVs, requires an enormous amount of copper, right? Nickel. How about all of the components that go into making batteries? Is it possible to even forecast the supply of these when you know that demand is so high and it's hard to get a sense of supply right now?
Well, that's the thing, a silver lining coming out of the chip crisis for us. We're a new company. We're spending a lot of time benchmarking others. We're talking to all our big tech partners, leaning into how they manage, complex, high-tech supply chains. And we're applying those learnings to what we're going to do with batteries. We need to get deeper into the supply chain. We've got to get to the source. We'll have to do strategic buys. We'll have to make sure that we have multiple sources for certain commodities that are going to be critical to us. So we're learning a lot from the chip crisis. We're going to apply that to our purchasing process, much more strategic. Our industry has typically been focused on just-in-time supply. We're shifting, more strategic, focusing on how we manage the risk as we work through the supply chain. And then for batteries, which are going to be a key component for us going forward, we're going to manage that, and we're going to be deeply involved in that from a strategic standpoint.
That was part of Bloomberg's exclusive interview with Ford CFO John Lawler. Well, we're joined now by Tom Keene, co-anchor of Bloomberg Surveillance, fresh off a long weekend. Good morning, Tom. What are you watching on this Monday morning?
I'm watching next weekend. I hope it's as long as the last weekend.
You and me both.
Kayleigh, we're looking at equity markets lift, and part of that is what the fixed income space is doing. You start the month with greater negative yields. We had a negative 2.00% on the 5-year, not the 10-year, the 5-year inflation-adjusted yield. It's an interesting chart. The 5-year giving you more oomph than the 10-year, even though the 10-year is really sort of the benchmark. There, down we go to the oddest of odds. Kayleigh, none of this at negative 2.00% is in the textbooks.
What are you watching in terms of the Delta variant? I mean, it seems to have popped up again, Tom, in terms of fears.
Here's what I'm watching, Matt. I was pretty aggressive on the weekend on this on Twitter. I think it's hysteria. I started talking about that last week, Matt. We got to go back to science. It's all there is to it. Look at the science, not at the hysteria that's out there. Frankly, I think we're in a pretty good space if we are vaccinated. If we're not vaccinated, it's not a good space.
All right, Tom Keene, keeping us all level-headed this morning, as always, co-anchor of Bloomberg Surveillance. Thank you so much. And, of course, Tom, Lisa, and John will be joined by a number of guests in the next hour and beyond. Michael Shaul of Market Field Asset Management, as well as Lisa Hornby of Schroders. Now we're taking a look at what else we're watching. And, Matt, I would not be able to say that I'm surprised with a serious face. You are watching sports cars.
Well, I'm watching Ferrari, which is different than other sports cars, right? I mean, it's just on another level. And for years, the stock has been on another level as well. I was down on the New York Stock Exchange floor when they first went public. That was the first time I met Piero Ferrari, which was pretty exciting for me. Johnny Alcon was down there as well. And their margins have been the best in the industry. Just unbelievable, like margins for Hermes handbags rather than cars. But this year, their stock has really underperformed because they haven't really made the shift to electric the way others have. So I think everyone's going to be watching this earnings call, especially with an eye on what their spending plans are in terms of shifting to electric. Danny?
I also just want to know when their F1 team is going to get more podiums. Carlos Sainz finishing fourth, getting a bump up to third because of a technical issue. That's what I want to know. Maybe that'll help sales. Well, look, I am watching a U.S. ban on Chinese companies, specifically investing in them, took place at midnight. 59 companies. Investors have a year to move out of them. But what happens with that ban, considering that China has called for the U.S., saying we want more communications, specifically on overseas IPOs. So this is a clear point of tension when it comes to investing in the capital markets between the two. Is there any more action today, any more words out of Beijing and Washington, Kayleigh?
Certainly one of the top market stories of the time. I also am watching ISM manufacturing data that's dropping here in the U.S. at 10 a.m. Eastern time. We're looking for a print of 60.9, but it'll, of course, be an interesting read on what factories are dealing with any lingering supply chain issues and pricing pressures. And also keep an eye, too, on the employment index within that data. It dropped in June, showed the inability of employers to find and retain workers. So we'll see if that's the case again in July or if the labor side of that story has improved. More Bloomberg Surveillance is ahead. Stay with us. This is Bloomberg.